Welcome to the deep dive. Today we are taking a scalpel to one of the most opaque and complex contracts you'll probably ever sign. The life insurance application and well, the intense world of underwriting that happens behind the scenes.
It really is. I mean, this is a contract where an insurer agrees to take on the ultimate uncertainty, paying a death benefit in exchange for the certainty of you paying premiums.
And our mission in this deep dive is to map out exactly how they do that, how they quantify your unique risk and turn all this personal data into one single number, your premium.
That's it. And it's so relevant right now. This is an industry that was, historically slow to change.
Right, very paper-driven.
Exactly. But it's been forced to modernize at warp speed. Post-2020 especially was a huge accelerant. Insurers couldn't do in-person exams, so they leaned heavily into technology, AI, automation.
So we're seeing more electronic applications, virtual meetings.
They're becoming the standard. But, and this is the key thing, while the speed has changed, the core principles of risk assessment, they are as rigorous as ever.
That sets the stage perfectly. So we're going to walk through this whole process looking at the key players. The agent, you, the applicant, and the underwriter. And we'll focus on what details really, truly matter. Let's start with the agent. They're your first point of contact, and I've always heard them called the eyes of the insurance company.
That analogy is crucial, and it's still true, even if your meeting is over a video call. The agent is not the one who assesses mortality risk.
Okay, that's a key distinction.
A huge one. That's the underwriter's job, sitting in an office miles away. But the agent is the only person who physically or, virtually verifies who you are at that moment.
So if they aren't assessing my personal risk, what is their job then in that initial phase? What's field underwriting?
Their responsibilities are all about validation and integrity. First, they have to make sure the application is 100% complete and that the answers you've given actually make sense.
Okay.
Second, and they confirm identities. They're looking at your driver's license, your passport, making sure the applicant and the person being insured are who they say they are.
And witnessing signatures.
That's the third and maybe most important part. That's the moment you formally accept responsibility for everything you've put down on that paper. And then finally, they have to submit it and your first premium promptly. Any delay there is a delay in your protection.
And the application itself can be massive. Our sources say it can be anything from, 5 pages to over 50 pages?
No, easily. For a simple term policy, it's short. For a complex universal life contract, it's a novel. That's a huge amount of data the agent is collecting before an underwriter even lays eyes on it.
So once that application lands on the underwriter's desk, their job is to basically quantify the risk of death. How do they even start?
It starts with a number, a conceptual starting point. The underwriter assigns the life insured a baseline mortality risk score, and that score is typically 100.
100, so that's the average person.
That's it. It represents the standard mortality risk for an average person of your age, your sex, your general health profile.
Fascinating. So how do I get my score lower than 100? That's what everyone wants to know.
Right. Well, any factor that suggests you have a lower mortality risk than average will reduce your score. Maybe you have exceptional health, a really low-risk lifestyle.
And that gets you into those preferred categories.
Exactly. Preferred, super preferred. And that translates directly into a lower premium, the lowest warranted premium, in fact.
And conversely, if I have, say, a health issue or a dangerous hobby, my score starts to creep up above 100.
Correct. It gets adjusted upward. A history of heart disease, a hazardous job, all those things increase the score. That final number determines your risk class, from super preferred all the way down to what they call table ratings.
Substandard risks.
Substandard risks, where the premiums get significantly higher. And if your application is pretty standard, it can be approved in days. But once you stray from that baseline 100, the deep investigation really begins.
And that's where they start digging into the applicant. Not just the person being insured, but the person buying the policy. And it's not just about health. They look at 4 things: financial ability, insurable interest, justification, and your application history.
Yep. Let's start with the money. Financial ability. If you're applying for a big policy, the underwriter needs to be sure you can actually afford to pay the premiums, not just for a year, but for decades.
So they're looking at your job, your income, your net worth.
All of it. They need to see that you have the means to maintain the contract.
But maybe the most important legal check, especially if you're buying insurance on someone else, is this concept of insurable interest.
This is fundamental. It's what prevents life insurance from just being a gamble on someone's life. If you're the applicant buying a policy on someone else, You have to prove that you'd suffer a financial loss if they were to die.
And that interest has to exist when?
Critically, at the time the policy is issued. That's the only point in time that matters legally.
So what relationships count? I assume a spouse, a child.
Those are the most common, close family. But beyond that, it comes down to what's called a pecuniary interest, a monetary stake.
Like a business partner.
A business partner, a creditor insuring a debtor, anyone who stands to lose money.
And let's talk about that point-in-time rule with the Isabel and Justin example. I
Yeah.
think this really clarifies it.
It's a perfect illustration.
Yep.
So Isabel and Justin are married. Justin buys a $500,000 policy on Isabel's life to protect the family. Years go by, they get divorced, Justin remarries.
So he no longer has an insurable interest in Isabel.
None at all. But because the policy was issued when the interest did exist, when they were spouses, that policy is still completely valid. Justin still owns it, he pays the premiums, and he would get the death benefit. He just couldn't go out and buy a new policy on her today.
The rule is locked in at the start. But there's a huge exception to this whole insurable interest thing, right? One that involves consent.
Yes. The entire requirement is waived if the person being insured gives their explicit written consent.
So that's why they always have to sign the application.
That's it, unless they're a minor. This brings us to Caleb, your extreme sports-loving neighbor. You see Caleb getting ready for some dangerous climb and think, wow, you have no financial interest in him whatsoever. The only way you could legally buy a policy on his life is if he agreed to it and signed that application himself. Without his signature, it's a non-starter.
Okay, so beyond that, underwriters also scrutinize the justification of amount. The policy should restore you, not make you rich.
That's the core idea. It's about indemnity, not profit. Look at the Frank and Susan example. Frank's a high earner, making $250,000 a year. They've got a huge mortgage, 3 young kids.
And Susan applies for $7.5 million of coverage on Frank.
And an underwriter sees that as totally reasonable. It replaces his lost income for years, covers the debt, gets the kids through college. It restores the family's financial position.
Okay, now contrast that with Jack and Jolene. They're older, kids are grown, they rent, and their combined income is, what, $65,000?
Right. So if Jolene applies for that same $7.5 million policy on Jack's life,
Red flags everywhere.
immediately, it's completely out of proportion to the actual financial loss. It looks like speculation. The insurer would probably offer a much smaller amount, maybe a couple $100,000, or just decline it outright.
So once those financial and legal hurdles are cleared, the applicant has to actually structure the policy. And this is where it can get really technical.
It does. You're defining the roles. Who's the applicant? Who's the life insured? For a joint policy, is it first to die or last to die?
And then there's the beneficiary. Everyone knows you need to name one, but let's talk about the contingent beneficiary. Why is that so important?
It's crucial planning. The contingent beneficiary is the backup. They get the money if your primary beneficiary has already passed away. If you don't name anyone, not even a contingent.
It goes to your estate.
Exactly, which means it gets tied up in probate, it's subject to creditors, fees, taxes. Naming beneficiaries ensures the money goes directly, quickly, and privately to who you want.
What if I want to lock in that beneficiary
Yeah.
so that I can't change my mind later? That's the irrevocable designation.
Precisely. If you name an irrevocable beneficiary, you, the policyholder, give up your right to change it without their written permission. You also can't borrow against the policy or make other major changes without their consent.
Why would someone do that?
It's often used in divorce settlements to guarantee spousal or child support, or in really complex estate planning to make sure the policy stays outside of your taxable estate. It's a powerful legal tool.
The application also forces choices on policy mechanics, especially with permanent insurance. For universal life, you're choosing how the cost of insurance, or COI, is calculated.
The COI is just the internal charge the company takes from your policy's cash value each month to pay for the death benefit. You have to decide if you want that charge to be level for life or if you want it to start low and increase every year.
And that makes a huge difference to your cash value growth over time.
A dramatic difference. And another little detail. If you choose to pay your premium monthly instead of annually, you get hit with something called a modal factor.
Okay, what's a modal factor? Why should I care if I pay monthly?
You should care because it costs you more money. It's basically a small fee, maybe 3 to 6% a year, that the insurer adds because they prefer getting one lump sum annually. Over 30 years, that small fee really adds up and you're not getting any extra coverage for it.
Ouch. Good to know. And for whole life policies, you have to decide what to do with your dividends. And one option is using them for paid-up additions, or PUAs.
PUAs are a fantastic tool. Instead of just taking the dividend in cash, you use it to buy a tiny, fully paid up slice of additional insurance.
So it adds to your death benefit.
It adds to your death benefit, and it generates its own dividends in the future, which then buy more PUAs. It's this self-perpetuating cycle that can seriously turbocharge the growth of your policy.
Okay, let's pivot now to the life insured. This is the part of the application everyone thinks of, the deep dive into your personal life and health.
And it is exhaustive. They want personal history, name changes, social insurance number, any history of bankruptcy is a big one.
But the real flags come from the lifestyle questions, the things you might not expect.
Absolutely. They drill down on avocations, dangerous hobbies.
So skydiving, rock climbing.
Skydiving, scuba diving, any kind of competitive racing. If your hobby increases your odds of dying, your premium is going up. Or they might add a rider that excludes death from that activity. They also look at travel plans, especially to high-risk countries. They look at your criminal history and your driving record. A recent DUI or a pile of speeding tickets shows a pattern of risk-taking.
And the classic smoking question. It's not just cigarettes anymore.
Not even close. That question covers any use of tobacco cigars, chewing tobacco, and also e-cigarettes, vaping, and marijuana in any form. Even using nicotine patches to quit can land you in the smoker category, at least temporarily.
Then comes the big medical section. Height, weight, your doctor's name. But what if you have had an issue? What kind of detail are they looking for?
They want everything. They provide a long list of conditions, cancer, diabetes, mental health issues, and ask if you've ever been treated for or even investigated for any of them. Let's use the Rebecca example. She went to the ER once for some chest pain. All the tests came back negative. It turned out to be stress. She still has to answer yes to the question about having a heart investigation.
And that yes triggers a follow-up.
It triggers a full report. The underwriter will want the doctor's name, the date, what tests were run, and the final diagnosis. They need the complete picture to assess if that one incident points to a higher future risk.
This all underscores how important total honesty is. Let's break down what happens when you're not fully truthful. There are three issues, right? A mistake, fraud, and just incomplete information. Let's start with an honest mistake.
A mistake is an accident. You got your birth year wrong, you forgot about a minor surgery from when you were a kid. The key question for the insurer is whether that mistake is a material fact.
Okay, define material fact in the simplest terms. What makes a mistake a big deal?
A fact is material if, had the underwriter known the truth, it would have changed their decision. They either would have charged a higher premium or they would have declined the application altogether. So look at the Christina example. She accidentally writes her birth year as 1954 when it was really 1945. That is a material mistake. The risk for someone 9 years older is completely different.
But forgetting you had a flu shot last winter, not material. It wouldn't have changed anything.
And this is where the contestability period comes in.
Right. For the first 2 years after a policy is issued, if the insurer discovers a material mistake, they can void the contract and refund your premiums. After those 2 years, the policy becomes incontestable for mistakes.
So you're safe after 2 years, unless it wasn't a mistake, unless it was fraud.
And that's the giant exception. Fraudulent misrepresentation is about intent. It's when you knowingly provide false information or you deliberately conceal something important to trick the insurer into giving you a better deal.
And the Eric and the parasite story is a chilling example of this. It is. So Eric gets a serious parasite while traveling. His doctors warn him it could cause long-term liver damage. When he applies for life insurance, he deliberately says nothing about it because he knows it would skyrocket his premium.
And he dies 3 years later, so after the contestability period.
Right. He dies from liver failure directly caused by that parasite. Because the insurer could prove he intentionally concealed a material fact, that's fraud, they were able to void the policy and deny the claim, even after 2 years. Intent to deceive blows up the whole contract.
It's a powerful lesson. Honesty isn't just moral, it's contractual. So what if I just leave a blank space on the form?
That's just incomplete information. It's not fraud, it's just a delay. The underwriter will just send the application back to your agent and say, get this filled in. The risk for you is that you're totally unprotected while you're waiting.
So this deep dive really shows that the application is this comprehensive risk assessment. It balances your finances, the legal justification, and all these granular details about your life and health. It's a system built to assess risk, not to be gamed.
And we have to end on one final critical point. The underwriting doesn't technically end until the policy is delivered. At the moment of delivery, the agent has to confirm that nothing material has changed about your health or finances since you signed the application.
So if you got diagnosed with a serious illness in that waiting period,
You have to disclose it. If you don't, the contract could be voided later on. Once the agent is satisfied and delivers that policy, the contract is officially complete.
so here's a final thought. Considering how deeply underwriters look at risk, what non-obvious lifestyle trend, something that's blowing up right now like competitive video gaming or maybe these extreme diet fads, what do you think AI-assisted underwriting will start flagging as a significant material risk next? Something to mull over.